Hi, this is Yashu Gupta, Senior Associate in the Investment Banking Division of DPNC Advisors. Today we are going to discuss why family offices are becoming the next private equity in India. Everyone speaks about private equity as the dominant source of growth capital in India. But one of the more important structural shifts happening quietly is the rise of family offices as a serious domestic equity capital pool. And the numbers are beginning to tell the story. According to EY Julius Baer Indian Family Office Playbook, India has 300 plus active family offices compared to just 45 in 2018. That is nearly a 7 times increase in 6 years. Think about what that really means. India is witnessing the formal institutionalization of private wealth at scale. This is no longer about wealthy families passively owning assets. It's about wealthy families building internal investment platforms. The same report estimates that India currently has around 13,000 ultra high net worth families, and this number is expected to rise to 19,000 by 2028. That implies a future pipeline of new family offices, new allocators, and new private market investors. Even more significant is the expected USD 1.3 trillion intergenerational wealth transfer in India over the next decade. Whenever wealth transfers at that scale, the capital structures evolve. And family offices become the natural vehicle for governance, succession, tax efficiency, and importantly, investment deployment. Now let us look at allocation behavior. The EY Julius Baer report notes that Indian family offices are increasingly allocating towards global equities, private equity, venture capital, real estates, and alternatives. Interestingly, 57% of family offices still allocate less than 10% of portfolios to PEVC. Why is that interesting though? Because it suggests private market penetration is still early. Even a modest increase from sub 10% allocation to 15 to 20% allocations could unlock billions of dollars into growth equity over time. This is why founders, bankers, and private equity funds should pay attention. Family offices behaves differently. Unlike PE funds, it is often not constrained by a 7-year fund life. Unlike venture capital, it may not require hyper growth narratives. Unlike lenders, it can absorb equity risk, which means it often becomes patient, flexible, strategic capital. My broader view is this: the next decade of Indian private markets may not be funded only by global PE funds or venture capital firms. A significant share may come from domestic permanent capital, and family offices could become one of the most important equity investors in that transition. In many future transactions, the smartest check may not come from a fund. It may come from a family office. Thank you.